The Bank of Canada doesn't care about the value of your house. Yes, that's correct. I'm going to be doing a reaction video from a video I saw on BNN here last week. Steve Gregario from Canoe Financial is going to be breaking down his thoughts on the economy. I'm going to be doing a reaction here as well. Steve's a little bit of a dry guy here, but I'm going to spice it up a little bit. I don't agree 100% with everything that he's saying here, but there is some truth and there is some things that you should really be paying attention to here as a real estate investor. So let's jump into this reaction.
What does this mean for our country's efforts to get inflation under control as we see the Fed raise rates by 75 basis points and the likelihood that Canada does the same is increasing? Let's bring in Steve Gregario, portfolio manager at Canoe Financial.
All right, so just first of all, I'm probably not gonna watch every single minute of the video here, just to let you guys know. I will be fast forwarding to like the juiciest parts as well, but it's really interesting that, Canada was talking about doing a 50 basis point rate hike all the way up until now. Our neighbors in the US were like, no, we're gonna do 75 basis points. So then Canada's like, yeah, that seems like a good idea as well. So it's over 2 weeks away, but it'd be interesting to see, is it really necessary that Canada has to hike just as much as the US, because they sneeze, we have to sneeze too? I guess we'll see here, but let's dive into the video here again.
So we heard from the finance minister in Canada today, Chrystia Freeland, talking about ways to make the inflation situation easier on Canadians, but also pointing to the responsibility of the Bank of Canada to do its job. I just wonder, where do you think markets are expecting inflation to go at this point? Because as we saw in our market update, North American markets are way down today.
Now, in full context, this was on the 17th, and right now it's the 23rd. So it has had a few days for the market to continue to ramble on. It's actually gone down a little bit more. So yes, there was some definite sell-offs last week.
Whether it's Minister Freeland or the Fed in the US, I think what we're seeing here is the realization that rates are going to be longer and higher for a prolonged period of time. And when you think about whether it's here in Canada or the US and trying to take down this inflation.
So he uses the words prolonged period of time. I mean, what could that be? Could that be 6 months? Could that be 3 years? Like, I'm hoping it's a little bit more on the short side versus the long side. I know that we're in a bit of a mess here, right? So everything that's been going on with this pandemic, where there was cheap money and we're really trying to stimulate the economy, everything to do with inflation and the economy, it's really like trying to thread something through the eye of a needle, and it's not very, very easy to do. Controlling the monetary, the whole policy here is not the easiest thing in the world. So by them manipulating interest rates here, it's really like trying to land an airplane on a very narrow sidewalk, I guess would be kind of the analogy. Very few times, have we actually gotten it right and avoided recessions here before we've seen all these rate hikes.
Many of the problems aren't really affected by higher rates. So the Fed can't print more oil, they can't print more baby formula, and for all intents and purposes, now there's a shortage for female products out there. So I think what you're going to see is the central banks across the world.
It's really interesting how he talks about printing oil and baby formula and female products. Not that I don't think those things are important. Yes, oil impacts everything. I mean, oil is going to impact, the cost of oil, the cost of gas. That's going to impact everything that needs to be transported. But why don't they just talk about groceries in general? Like, groceries in general are up massively here over the past year. Probably a little bit more than some sectors, especially if you like to eat healthy and like to eat organic. Why don't they pick more things that the average Joe can relate to? I found that interesting.
Taking down other parts of the economy. So when you think about Apple and cell phones, that's one area. Clothing, that's one area to alleviate pressure. So I think we're in the early innings right now.
What are your thoughts? Is Apple actually going to be affected by what's going on in the economy here in the next couple of years? I don't know. I think they're still going to keep selling iPhones. People will find a way to have those kinds of products, those vanity products that they really want to have. I think it's going to be more like the Walmarts and the Targets of the world. They're already doing massive price cuts. I think it's Walmart that announced that they're going to be doing 10,000 different price drops at their stores, and they're going to continue to do so more here in the next quarter.
The hope of a V-shaped recovery in the equity market is dwindling. We don't see that happening. And the same for the bond market. So we think we're going to slug around here, around these levels for some time.
Now you can see this drop here last week of 3.29%. That's a pretty big move for the market. That doesn't happen every single day. So, definitely the reason why they've been filming this video here.
To come.
How willing do you think the Federal Reserve is to accept a recession in order to get inflation under control? You talked about tackling different parts of the economy there.
Did they just say accepting a recession? It's just like, is this just something we decide to accept or not accept? It's really interesting wording. I find it. I really should have some popcorn here to be eating while I'm watching this here.
I think the only thing we can take from the conversation yesterday with the Federal Reserve is they are going to war against inflation, and employment no longer matters. And that's very different rhetoric than we had last year. Last year it was all about employment, not about inflation. I think ultimately you never want to fight the central banks, and they're telling you right now that employment is going to become tough. If I was a home-based employee, I'd be running back to the office right now hoping not to get laid off, because ultimately I think employment gets tough, rates go higher.
Now, really interesting, employment doesn't matter anymore? I thought employment always mattered. How would you feel if your job was all of a sudden on the cutting table, right?
You're fired.
But my number one advice would be to make sure that you become somebody that's very hard to lay off. Make sure that you're always delivering outstanding value to the marketplace and to the workplace so that you're not on the chopping block when it comes to your job.
And they're just going to crush demand in the short term. They have to save face, and ultimately they have to do it quickly. And we'll probably see another 75 down the pipe sooner than later.
In terms of the bank.
So do they really have to do it quickly? I mean, could they not, raise and then wait a little bit? Maybe they actually wait, a month or two without doing, something, or did they just feel like they have to absolutely slam the brakes on? Is there more going on here that we don't know about?
Now to be following the U.S. Federal Reserve's lead and going with the 75 basis point hike. But we've spoken with market analysts who have said that the Bank of Canada is going to hit a ceiling before the Fed does because of how sensitive the housing market is in Canada.
Now watch, this is where the video gets really good here, gang, where they start to talk about the Canadian market. The Canadian real estate market is a little bit different than the U.S. market. I mean, we're a much smaller market. So I think it's important to realize that we're not exactly just like another state of America. We are our own country, and we do things a little bit differently here when it comes to due diligence on our mortgages.
Where do you stand on that?
Yeah, here's probably what I would say on that one. I don't think the Bank of Canada cares about the value of your house. In reality...
Whoa, did you hear that? They don't care about the value of your house.
You'll forgive me if I don't think about monetary policy.
I mean, this guy's a little bit dry, but he's starting to come to life here a little bit, and just dropping what he feels is the truth. And maybe there is some truth to it. I don't know if that's the only truth. If they don't care about the value of your house, I guess because they're starting to get a bit of reaction now. Overall the housing market has started to cool by 10 to 20% in a lot of markets. I guess that's not enough for them. They need to make sure that goes down by even more. So let's see what else they have to say here.
They care about inflation. When you decompose the housing market here in Canada, 37% of Canadians are renters, so agnostic to interest rates related to mortgages. 28% of the population or of how.
Now, just because someone's a renter, that doesn't mean that they don't want to buy a house in the future. So it just makes that home affordability even further out of reach with the interest rates going up and the holding costs of owning a house going up by quite a bit as well here too. Now, I do understand they want to curb inflation, right? They really want, this is the highest inflation we've seen in 40 years. So, I guess my question is, do they need to go for some of these record hikes and be doing them so often?
Of households do not have a mortgage. So that leaves about 35% of households with a mortgage. And in reality, when you decompose those mortgages, very few of them are sensitive today to interest rates move. They're sensitive over the next 2, 3, 5 years.
All right, this is a point that I really have to disagree with. If they keep raising interest rates, sure, if everybody was locked in at, let's say, 2.5% as far as their mortgage, yeah, it wouldn't affect them for quite some time. But there's a lot of people in variable rate mortgages. I actually recommend that real estate investors be in variable rate mortgages as much as possible. And that means that the mortgage costs are going to be going up, right? It's always, whatever prime is plus, whatever it's going up by. So are we not going to be sensitive to it in the short term? I think every rate hike, it pains our pocketbook, okay? So if that changes, the cash flow in one of our properties, if it was $1,000 a month, which would have been extremely healthy, if now that's down to 500 and now it's down to 250 or zero, I make up that actually, we feel that right away, not 2 to 5 years from now. Give me a break, guys.
And that's just the structure of Canadian mortgages. There's only 2 banks that actually raise variable rate mortgages when prime goes up. So it's going to take time for that to feed through the system. So the hope that the Bank of Canada cares about the value of your house, they didn't care about it on the way up. They won't care about it on.
So guess what? The banks that a lot of Canadian real estate investors use are actually the banks that do change your rates, okay? I know one of them is Scotiabank. So every time that they do a rate hike, I get all these letters in the mail. I got a big stack of them that, hey, it's like, your monthly payment has changed. So yeah, I mean, TD and some of these other banks, real estate investors don't use them as much. So it's not really applicable.
It's extremely volatile times. Do you see this volatility continuing?
Yeah, so this is a really interesting question. And it's an interesting time also because what's been missed here are 2 things. The first is options expiry is tomorrow, and it's actually triple witching. So I think you're seeing a little bit of added volatility today as people position for tomorrow. Tomorrow might be, and for all intents and purposes, if you can't handle volatility, you probably don't want to turn on your screens tomorrow. Tomorrow should be pretty volatile.
So no doubt that the stock market is going to be very volatile. It's going to continue to be volatile for a very long time. And we're seeing a lot of different sectors becoming volatile here. Really, things are changing daily, things are changing weekly, things are changing monthly. So I'm probably not going to watch the rest of this video here, but I did want to let you guys know, just it's so crazy that, the Bank of Canada doesn't really care about the value of your house. At least that's what Steve's saying here. And I'd be interested to know what you're thinking here as well. Drop a comment below. Make sure you've subscribed to our channel here if you haven't already. Give us a like. It really shows the algorithm that we're relevant and that people want to see our videos here. Yeah, these are interesting times. There's still a lot of value out there as a real estate investor. There will be deals, but don't let videos like this scare you away from investing in real estate or investing in general. This is when the smart money comes out to play, right? Smart money knows where the value is. Smart money is always going to go and invest itself in value as long as there's a smart person controlling that smart money, all right? So hope you like this reaction video. If you do, let us know. And I'm looking forward to doing more of these here so you guys can watch along and learn my thoughts and assimilate them into your own life as an investor. Cheers.